is decided upon. But at this stage, we're trying to decide on the closing bell what the macro trade is, because as I said, if we make that trade, we don't have an overnight session to deal anything, so it's going to be defended. Overnight trades are always defended. So when I look at these closing prices at any of these closing bell areas here, my automatic decision is made about value. I need to make a decision because these are critical levels, massive levels for me to make decisions at. Now, whilst that's the case, there's got to be a macro involved in it. There's got to be a macro value. One of the macros we've been talking about recently has been the rotations. We covered it in yesterday's classroom, in fact. We even looked at it against the STI report on the S&P dropping by 10%, and we saw this morning, in fact, that Morgan Stanley also brought out an analytics piece that said that they expected the S&P to drop by 10% as well. So when we're looking at the closing bell, take a look at these closes in the last 2 days here. This close was massive for a sell, and the following day we had that brilliant sell-off. Last night was a classic closing opportunity to sell. And again, we had this brilliant overnight session, RGL, that we simply just lent against. As soon as it went red, I was selling. As soon as it went red, I was selling. Now, you don't have to make that decision at the closing bell. You can just wait for the RGL, guys. I'm not expecting you to get involved in the fight at the closing bell itself. Just wait for them to sell below the RGL when the sell is there. Now, why would these two be so obvious? Why would we pick on these two? Just because they worked? No, because they're macro trades into macro highs with macro values. When we look at the rotation, the macro value should be very obvious what we should be doing with the closing volumes. Remember what we keep telling you in your charts, that the biggest volume is the biggest decisions, the biggest liquidity is the biggest reversal decisions. Well, the one thing about the S&P you must know for 100% certainty is that the closing bell is the biggest liquidity, it is the biggest volume. So if somebody wants to get a macro short trade on, that's when they'll do it. So when we see those closes at the highs, but we see macro value short, you know what the deal is going to be. Almost 100%, you'll know what the deal is going to be. There hasn't been anything as obvious as these closes here and here because of the bearishness of the big rotations. Hasn't been anything near as obvious as these trades. But if you look at the close, for example, on this day here, take a look at how low the close was on this day here, 2030. You can see that that close is too low for the macro value bullishness that we've got in the background. There's a divergence off the low price. We've tested back into the lows. That is going to be a trade that the big boys may decide to take advantage of at the closing bell. And we get this lift off the price very, very nicely into a close. Now that macro is still pretty good. The overall macro is still pretty good. You can see here's a good example of an open that's overpriced. So obviously this is another example of a trade that you'd look at and say, well, the open is overpriced. The commercials are probably going to sell that open. So once the price rotates up, rotates back through the open, and starts selling off through the open, you can join in. It's an RGL again, isn't it? It's another RGL opportunity. And we can obviously see these macro trades simply by watching our charts on a macro scale basis. If we're too busy concentrating on a 1 second chart or a 5 second chart or a 1 minute chart, we may have forgotten all about the value that we're getting on a macro scale. More so in the evening session, because a lot of you guys don't trade, as far as I'm aware, at the close, which is a pity because the massive opportunities at the close every day. But you should be able to start recognizing what the commercials will do with the biggest single volumes. Every time we come into a close, we should be able to see very clearly whether there's any macro trade. There might not be any. It might be fair value. But at the open, we might also get some. There is no question about the amount of macro value that's available for the closing bell yesterday and the closing bell the day before. We can see the amount of macro values that we can get on those two trades. Now, in addition to that, we can also see what the pricing of volatility was, can't we? We can see whether the pricing of volatility was starting to become more expensive. Inside the day chart, we get day swings, we get day values, we get day storylines, we get intraday, we get the daytime scalpers. We start seeing the scalpers picking up some short-term business against some short-term swings, which are going to last maybe for a half hour or an hour. Well, those are all day scalpers. These are all the individual days. So we have a day slope here, which is perfectly applicable for anybody on the 5 minutes, 1 minute charts, 3 minute charts, or whatever. We can see the day swing scalpers. We can see a bit of value at the bottom edge to buy into. There's a nice opportunity to buy equities right at the low test. And you can see that the trade obviously made some pretty good progress. It's only declining. It's only not showing up as a big profit because of the gap down we had on the open. If we get rid of that gap part, you can see that this actually shows up almost like for like in terms of price. The higher highs, higher highs, higher highs, higher highs. This one was the only one that started to diverge a little bit at highs, higher highs, and then a higher high. So on a day chart, we use day values. We use that small short-term swing value to see whether there's an opportunity. But on a macro scale, which takes advantage of macro volumes, remember, it's at the close that we need to try and find this storyline. So when we come into the closing bell here at 9 o'clock, I want to now be not looking at this short-term value, although I still pay attention, especially at the MOC decision. So the market and close at 10 to 9, I start to be positioned perfectly for whatever the algorithms do at 10 to 9 to try and capture a 10-minute scalp trade. But coming into 9 o'clock, this isn't the chart I'm really looking at. This is the chart I'm looking at. I want to know how much value is in there at 9 o'clock on a macro scale basis against several measures. The volatility, the rotations, and the quality spreads. The big measures, the 2's curve, the 2's curve, the big measures. So when we start to recognize that the 2's curve, the volatility, and the rotations, the defensives against the not the rate sensitives, but the defensives against the kind of growth stocks, those types of rotations, then we can understand something here. We can understand that the macro trade is going to be short at the close for the last 2 days. So into the closing bell, I want to work short. We give out a level. You don't need me to give you out a level. You can draw it on your chart yourself. It's called settlement. It's called settlement. And all you've got to do to take advantage of this trade is trade settlement. You trade it as an RGL. You buy settlement or you sell settlement. Once it goes through those levels, you take advantage of what happens next. So settlement last night I did as 74.75. 74.75. This is the S&P futures contract now in place. We can see here that this is at 20.59. So this is the closing bell on this pin, isn't it? That's the closing bell right there. There's the final settlement price. The price went up through settlement. But I know that the trade is a macro short. So there's two things you can do as a commercial. You can sell that higher price. Or as a local, you can simply wait for the price to trade below settlement and start working offers in this area. Start thinking about the idea of working offers. Start waiting for selling to come in and then start executing against those offers there. For guys in the States, this is a good time of day. You're not even broken for your dinner. You've not even sat down for a meal. Even if the partner was saying, are we going out for dinner tonight, you've still got time to put in your overnight trade, your closing bell trade, and still have time to get suited and booted and ready to go out for a razzle-dazzle. Plenty of time to do that. For the Asia Pacific, of course, slightly more difficult because it's in the middle of the night. For London, very, very easy because it's 9 o'clock at night. It's not that late. I don't know anybody yet that goes to bed at 9 o'clock. So therefore, it gives you opportunities. London, Europe, USA, West Coast, East Coast. Gives every single person except for the Asia Pacific guys an opportunity to get into a short play. And once you're in that short play, you can obviously put a hard stop just behind the RGL up here. And once it breaks south, you can put your hard stop into break evens. And you can go on your night out. You can go on your night out at that stage. When you come back from your night out, of course, you're either scratched out at break even, or, as happens in this occasion, you end up getting this very substantial drop from 44.74s to a low price of 44.46s, and you're nearly $1,500 in profit by the London Open. $1,500 in profit by the London Open from a trade that you took a few minutes to do, a few more minutes to check your stops at break even, and then went out for your dinner or took the rest of the night off and enjoyed your supper, and then went to your bed and woke up the next morning $1,200, $1,300 better off, and thought to yourself, wow, that was worthwhile, wasn't it? Bearing in mind that a similar situation happened, of course, on the previous day, didn't it? On the previous day, we had a similar situation, which if we go back to the US close again, we can see what happened. 2100 hours. Here it is here. There's the 2100 hours right there. There's your RGL. We were obviously bearish. We were selling. So obviously as a trader, you'd have been knowing that that was the case because you saw the huge divergence 2 days ago from the quality spreads and from those rotations, those defensive rotations against the aggressive attack stocks. So we start thinking to ourselves, right, I want to be short. If you sold onto this first break, you're still in it. If you sold onto the second break lower, you're still in it. If you sold on the pullback, then guess what happens? You get your stops into break even. When the market breaks, you bring your stop into break even now, and that's you. Finished for the day. You go to your bed. And what happens next is that the following day, of course, the market collapses. And obviously, as we go into the US Open, you can see that we went from a high price of 44.62s. By the time we reached the London Open, we were at 45s, not quite $1,000 on that occasion, but obviously a pretty good trade, considering that you were focused at that time of night, that idea of being specific. The only challenge you've got is that a lot of the times there isn't a trade at that time of night. A lot of the times the value that you can see is fair. There isn't something that's screaming at you, this is going to be a good one. This is going to be a macro sell or a macro buy where the big boys need to defend these prices because they've got too much size if they don't. So you can start to recognize how easy and how nice these types of trade opportunities really are. And they don't take a lot of time out of your schedule. They don't take a lot of time to calculate out what's going on. All they do is require you to remember to go back into your macro. Now, when you go back into the macro, of course, the open is another macro time that you could do a bit of business, isn't there? So when you come into a macro open each day, you're doing the same question. You're asking the same question. At the open, do I want to be short or long? Now, that's not going to be based upon the 1 minute that you've just seen of data. It's going to be based upon what the macro was doing at the open. It's going to be telling you that we've got a big gap on the macro. My goodness, we're going to be selling it. So you start thinking about getting short against that break of the move here. And you start getting into the short phase of the US Open. The opening play, of course, is what you're trying to do. But the opening play isn't based upon short term. It's based on macro, because the macro trade from the night before, if there was one, and if there wasn't one, they'll be looking for a possible macro trade at the open of the next day, because they're looking to try and get big volumes in, and the biggest volume of the day happens to be the open and the close. The close being the biggest, the open being the second biggest. Two huge opportunities to make a lot of money. Two opportunities that the vast majority of people avoid because they're scared of opens. They're scared of volatilities. They're scared of those elements. You shouldn't be scared. They are very, very, very good opportunities to try and trade. So if you have a desire to make some cash tonight, have a look at the close. Take a look and see if you see anything that really stands out. Don't take a wild shot in the dark. Wait until the price trades through the RGL. Try and work an order into that position, and after it breaks in your favor, if it breaks in your favor, you may well have got stopped out at break even. But after it breaks in your favor, get your stop into a break-even trade, and then of course that's you finished for the day. If it breaks south in line with the macro in the overnight session, you're waking up the next day with an incredible profit. If it doesn't, you don't. You walk away with nothing. One tick profit perhaps, $10. You go, fair enough. Fair enough, guys. That's the way it works, right? Anyway, 10 seconds to US data. So careful, careful, guys. Careful, careful.